GameStop.
GameStop.
This struggling video game retailer's shares were worth a few dollars in 2020. By January 28, 2021, they peaked at over $450.
GameStop's stock is surging.
The frenzy was seemingly caused by a Reddit forum called Wall Street Bets. It has millions of members who hoovered up shares in GameStop in what has been touted as a battle between Wall Street and vigilante day traders who wanted to stick it to the establishment investors, sending shockwaves through Wall Street and even raising alarm at the US Treasury. Some trading platforms eventually restricted trading of GameStop shares. What does this reveal about the US stock market? You've submitted your questions, and Alice Fulwood, our Wall Street correspondent, and Henry Kerr, our economics editor, have answered them. Why did trading platforms like Robinhood restrict people from buying GameStop shares?
The decision that Robinhood took to halt trading of GameStop shares has been extremely controversial, so it is worth digging into sort of why that decision was taken. At the moment, the sort of likeliest theory seems that they were struggling to cope with the sort of sheer volume and sheer amount of interest that users of Robinhood had in GameStop shares. There are estimates out there that half of all of Robinhood's customers had some exposure to this stock. Those pressures may have sort of contributed to Robinhood's decision to halt trading. But the bigger picture is that although this sort of one retail brokerage made the decision to halt trading in GameStop shares, that was because it was sort of uniquely positioned and sort of uniquely exposed to the dynamics in this. Most other retail brokerages, with the exception of a couple others, did manage to keep trading GameStop shares open because they weren't as exposed to the dynamics as Robinhood was.
What is short selling and what is a short squeeze?
So short selling is where investors bet against a stock, and the way they do that is by borrowing the stock, selling it, and then hoping to later buy it back for a lower price to give the stock back to its original owner, and they then pocket the difference in the interim if the price falls. So it's just a standard way that investors would bet on a stock going down. A short squeeze is when it becomes difficult for the person who shorted the stock, i.e. the person who's borrowed and then sold it, to get it back again. And the reason it's difficult is because the stock has become a lot more expensive in the meantime. So they get squeezed. And because if I'm a short seller, I'm contractually obliged to give back the stock that I borrowed, I essentially have to go into the market and buy it, however high the price has gone. The only alternative is to breach my contract or to go bankrupt. So a short squeeze is just when there's lots of people who have shorted a stock and the price of that stock goes up a lot and it becomes hard for the shorts to get out of their trade. And that's precisely what's happened in the case of GameStop.
Has GameStop shown there's one rule for Wall Street and another for ordinary people?
Inevitably, yes, because the hedge funds who operate every day on Wall Street and have massive amounts of cash and have cash to invest and have all the best software and platforms and connections and terminals and all these things, you're never going to be able to match that as a retail investor sitting at home. So it's inevitable that there's going to be an asymmetry there. The more controversial edge to that question is whether or not regulators or the system is in some sense conspiring against the retail investors, which I think is what people on the forum would tell you. Now, it's true that regulators are much more likely to take a paternalistic stance towards retail investors than they would towards hedge funds. I don't think regulators really worry that much about hedge funds losing money unless there's some sort of systemic threat to the system, whereas historically regulators have cared quite a lot about the idea that retail investors know what they're doing when they get into markets. Now, of course, there are a lot of people in the current situation who are buying GameStop shares who say we know exactly what we're doing and this is all a ruse saying that we don't, trying to protect us from ourselves to actually keep us out of this market which we're revolutionizing. But the thing is, it's got so viral now that of course there will be people who don't, and I think regulators will be interested in that.
It is interesting in the context of sort of how much access retail investors have now, though, compared with what they used to have in the past. There's so much direct access, the fact that it's frictionless now, whereas you used to have to pay trading fees, how much information is accessible sort of online and can be shared, between sort of regular investors. This is, and it can be hard to see this at the moment, sort of the most probably the most equal it's ever been between Wall Street and ordinary people. You shouldn't sort of lose sight of the fact that actually now is sort of a period of sort of great access of regular investors that contrasts with how things used to be.
It is the case that short selling in the market generally is something that aids price discovery. It helps the market function and work out what prices should be. Were it the case that short selling now always came with the risk that you'd sort of become an internet meme and have loads of people come in and buy the stock to implement a short squeeze, you might see that as a bad thing for markets, for price discovery generally. However, because what's happened with GameStop is so unique insofar as the short positions were so large relative to the liquidity of the trading, it's unlikely really that will be repeated again. But it's interesting that a lot of what's going on is people writing online that these short sellers are sort of, bad actors for having sold the stock short, especially during an economic downturn like the one we're in.
Yeah, short sellers are... they're easy to villainize, but they are not necessarily always the villains.
How have the authorities reacted? Should the situation be regulated?
There's definitely a sense from some politicians and kind of across the spectrum really, that it was not legitimate for Robinhood to have halted trading in the way that they did. I think that case is going to, or that argument is going to struggle a lot based on the sort of terms of service and laws as they're currently in place. There's also been this sort of broader discussion, I guess, of whether or not retail investors should have sort of as much access and should be able to trade sort of all the highly leveraged derivatives and things that they are trading. That's a debate that sort of is eternal on Wall Street and eternal with markets regulators.
What does GameStop tell us about the state of the US stock market? Is it overheated?
There's a sense in which what's going on with GameStop is an isolated phenomenon and is actually small relative to the market at large. But you could, the short squeeze, the what's going on with the options trading, which sort of has these momentum effects driving one's stock up very high. It has had spillover effects, but in general, I would view the GameStop thing as an isolated phenomenon. Now, of course, some people say, can't you look at what's going on here, which is a lot of everyday investors sitting at home punting on the stock market, and doesn't that tell you something generally about the kind of economic situation we're in? My take on that would be that the easy money is a response to the economic circumstance and high asset prices are a natural consequence, and it doesn't have to be a bubble for that to be true. But it is the case that I don't think this could have happened a year ago without the amount of liquidity in the system and without the amount of money in people's bank accounts as a result of the stimulus measures in response to the pandemic. So if you were someone who believed that the stock market is a massive bubble, this is a sort of string to the bow of your argument, because you can say, look, isn't it always the case in history that stock market bubbles are accompanied by these kind of mad pockets of exuberance? And isn't that what we're seeing here? I think I'd argue that what we're really seeing here is a sort of new phenomenon about the internet ganging up against the establishment and using financial markets to do so. And that's not something we've really seen before.
There'll be a lot of sort of digging into that point to really try and find out sort of how much was driven by initially sort of retail exuberance, but what role other factors played, whether it's this sort of derivatives trading, whether it's the short squeeze, or whether it's sort of big institutions piling in. Right now, the sort of story is that, it's all the retail investors against the hedge funds, but it may turn out that a load of hedge funds were on the same side as the retail investors all along, and that they were sort of a big factor in driving that stock as well. But I do think that it's kind of interesting that we've gone from sort of worrying about bubbles in companies that you might think would do well in the pandemic, the big tech stocks. And now this sort of forum has turned its attention on the sort of really unloved value companies, cinema chains, BlackBerry, Nokia, GameStop, etc. All of these firms are sort of the reverse trade of the bubble trade almost, because their sort of their business models and their sort of valuations were so depressed actually before this happened. So I do think that it's sort of slightly different from that dynamic.
That's a really interesting point about the hedge funds' interest now in the web forums, because of course that is what you'd expect. not only if you're an investor who wants to know where markets are going to go, would you be on the lookout for these sorts of phenomenon? If you were someone who potentially wanted to manipulate the market, you might try and start your own, meme on Wall Street Bets for one of these stocks, having invested in it in a sort of classic pump and dump scheme. So I would have thought that after this whole thing is over, there'll be quite a lot of interest in the form by investors, and also potentially some bad actors might see it as an opportunity to try and manipulate the market.
Has GameStop started a trend? Will this happen to other companies' shares?
I mean, I would fully expect that something similar might happen to other companies' shares, insofar as I think the widespread retail access to financial markets are here to stay. I think that Reddit's here to stay. These social media dynamics are here to stay. The sort of slightly populist dynamics of what's going on are going to be around for a while. They're a feature of how our society is at the moment. I do think GameStop was uniquely positioned for this to happen in terms of, as I've said before, in terms of the amount of short interest and the sort of thin trading in the underlying shares. So I'd be surprised if we saw anything as quite as remarkable as this happen again. But I think that these retail traders are going to be an ongoing force in the markets. Yes.
I'm Alice Forward, the